My name is Sean Sebold. I'm president and founder of Sebold Capital Management. We are an independent, fee-only wealth management firm that assists our clients in determining the who, what, when, where, why, and how of them selling their privately held company. Now, we're not investment bankers, but if you need a recommendation, we can make one. We're not business brokers, but if you need an introduction, we can certainly make them too. What we do is we help our clients and assist them in using our knowledge and experience to help them make the right decision about selling their privately held company. After all, there are no do-overs. Selling your business, specifically two different types of buyers. Now, there's a few more than two, but we only wanted to focus on two to give you an idea of some of the things that we look at. So, what types of buyers are we talking about? There are financial buyers and there are strategic buyers. And let's get into each one of their motivations and how that will impact the eventual seller of a business. So a financial buyer, they are specifically focused on the ROI, or the return on their investment, how much money they're going to make on the deal. They're also looking to buy the company and at some point resell it. So they're not going to keep it and hold it forever in general, financial buyer. They might keep it for 3 years and then spin it off, or they might, they're always going to spin it off to somebody. They're generally not going to manage the company. They're going to seek an undervalued business. So they have a pool of capital. They're going to look for a good deal. That's what a financial buyer is going to look for, because if they pay a lower price, their rate of return is going to be higher. Strategic buyers, very different motivation. They're going to look for companies with synergies, something that we can put two companies together and we can get a bigger bang in terms of our market-based return. They want to increase the value of both businesses. How they want to do that with strategic buyers really depends on where their industry and what they're focusing on. They're going to want to integrate into similar markets. So you're clearly not going to see a bookseller trying to buy a food manufacturer. Generally not going to happen. So there's going to be some kind of similarities within those markets for a strategic buyer for that to make sense. Okay, let's get a little bit more into the financial buyers. So again, their primary interest in making a profit. They have $100. They want to invest that $100 and get the greatest risk return that they can get. They can invest in anything. So it's all about that profit. They're buying the company for its earnings potential. So they could buy stock in Apple, they could buy stock in Intel, they could buy a privately held company. So everything is all about buying it and what that return is. They're going to be very well versed in the field that they're buying, because nobody wants to buy something that they don't know anything about. And they see your business as an investment. As I said, any other stock, any other investment will compete with this particular purchase. So the good things about looking for financial buyers, they have a lot of capital. So right now there's tremendous amounts of funds in the private equity space. They have capital to invest. They don't have to worry about going out and getting banker money in order to buy your company. They have capital. They generally will give you flexible deal terms. You know, how long do we have? What's the structure? What's the payout? Financial buyers, as long as the numbers work, they're going to be pretty good on that. Less intrusive. They're very unintrusive into the business on most parts, because they don't want to be involved in the business. They want to make sure the business grows, they make money on it. So they very unintrusive to the business. Comparatively speaking, pretty quick liquidity. They can make deals happen very quickly because they have an open checkbook. Okay, so again, financial buyers, it's all about the cash. The cons: higher capital does not guarantee a higher sale price. So financial buyers don't want to spend a lot. They don't want to pay too much because the return will be lower. So it does not guarantee the higher sale price. Businesses may take on additional debt payments. So if you're buying a company and there's no debt on the company, when somebody buys it, there's a strong probability that they're going to lever up the company. Why do they do that? Because if you lever up the company, your rate of return will significantly increase as long as that company continues in business. So that may happen. Buyer has more financial influence and power. So if they're a big financial buyer, there's lots of things that they can do in the finance industry that will impact that company. And they want the previous owner to manage parts of the business. So you're going to stay there. You're going to run the company for a while. So your exit strategy is going to be a little bit slower. Strategic buyers what's their benefits here? Okay, so what do they do first? 1 + 1 = 3 growth model. So if you own a business and someone's coming in and they say, I want to buy your company because you sell to XYZ company, we've been trying to sell to them for 10 years and couldn't get in. If we buy you, we can now offer our products into that company. Their products might have a really high margin, so therefore, if they buy you, they can pay a really big price for you in order for them to get in because it's going to be worth more to them. So that's that 1 + 1 = 3 thought process. You create a bigger brand, you decrease costs for some industries where you can get some synergies, you can combine talents. So strategic buyers have those benefits. They're going to be buying that business based on what they would do with it. Not what you've done with it, but what they would do with it. So here are the pros. They're generally going to pay more, and in some cases, a lot more. Owner can leave entirely. Again, they're not buying it for a financial business. They're buying it to integrate it within their business to make their business more powerful. So generally, owners can leave pretty quickly. Increase the value of the brand. So if they're taking yours over and they're a smaller company, you might see that brand be enhanced. Strategic buyers have synergizing assets. There could be staff. And some companies will buy another company just to get their employees. They might have good locations, good connections. So all of those go into the calculation on, is this a good deal? What are the cons? The synergy might not come to fruition. If you're a seller, doesn't matter. Employees may not agree with the transfer. If you're an employer who likes his employees and wants to keep them for a long time, strategic buyers are not going to be beholden to that. So that might be a problem. Customers could disagree with new management. Again, if you're getting a 2 times price that you thought you get from a financial buyer, that might not be an issue. But if you're looking to have that company continue to grow and the employees continue to grow, that might be a bit of an issue. Owner's name is tied to the buyer's actions. So again, if legacy issues are important to you, strategic buyer might not be the right way to go. So to conclude our short video here, knowing the potential buyer pool is a major factor in preparing a company for sale. So if you're looking to sell to a financial buyer, financial buyers are looking for something completely different than a strategic buyer. So knowing that up front will certainly position your company in a better way and position you from a valuation perspective. Have a strong influence on how you'll be involved in the company after the sale. Again, financial buyer is going to want you there. You're going to have an employment contract. It might be 1 year, 3 years. I've seen up to 5 years. So they're going to want you there. A strategic buyer probably wants you gone. So that also will have an impact on what's going to be more beneficial to you. Can have very different visions of what happens to the company in the future. Some companies, they're going to come in, they're going to buy your company, a good manufacturing company. They might shut down the plant completely. They might have just wanted the equipment, or they wanted you out of an industry that you were in. So all of those can become part of that selling process. You certainly don't want to prep a company for future growth if a company is going to come in and buy you and close that plant. That would be a lot of wasted capital that could go actually into the seller's pocket in a future transaction. So things to think about. These are things that we help our clients look at. For more information on how you can get some insights as to who, what, when, where, and why you're selling your privately held business, visit us at www.seboldcapital.com. Thanks for watching. Take care.